$580,000. That's how much a real couple from Vancouver put into Dividend ETFs. And today, right now, that portfolio pays them $9,200 every single month. They quit their jobs at 37, both of them. They've got 2 little kids, and last year they spent 7 months traveling through Indonesia, the Dominican Republic, and Panama. Now look, I know what you're thinking. I thought the same thing. That sounds way too good to be true. So I did what I always do. I pulled up the funds, I checked the yields, I ran the math myself. And what I found is a strategy that actually works, but it comes with trade-offs that almost nobody is talking about. And I think you deserve to hear both sides. So here's my promise. By the end of this video, you'll know exactly how they built this income. You'll know which funds they used and which ones you can actually buy in a US brokerage. And you'll know the one thing about their income that sounds incredible on paper, but isn't quite what it seems. That part is going to surprise you. But honestly, the part that surprised me most had nothing to do with picking the right fund. It was a single decision, one that most financial advisors would call irresponsible, and it changed everything for them. I'll get to that in a minute. Quick note, I'm not a financial advisor. Everything here is for educational purposes only. For your specific situation, always talk to a qualified professional. Before we go any further, take a guess. How much money do you think you'd need invested to generate $9,000 a month in dividends? Just pick a number in your head. By the time we're done, you'll know exactly where that number lands, and I bet it's not where you think. The move nobody saw coming. Alright, so here's their story, and I want you to really sit with this one because it hits different when you hear the details. This couple was living in Vancouver. He was a mechanic, not Wall Street, not tech, a mechanic. She ran a small online health consulting business from home. They had a townhouse, they had a little rental property, they were doing okay. But here's the thing, they weren't free. They were working, they were paying a mortgage, they were doing what everybody does, trading time for money and hoping it all works out someday. Then they stumbled across income investing, and instead of doing what you and I would probably do, put a few $100 a month into a brokerage, take it slow, see how it goes, they went all in. And I mean all in. They sold their home, their primary residence, took roughly $400,000 in equity and put it directly into Dividend ETFs. Then they sold the rental, another $100,000 in profit, straight into the portfolio. Total invested about $580,000. Now, I can almost hear some of you saying, that's insane. Who sells their house to buy stocks? But hold on, here's where the math gets interesting. Their mortgage payment, property taxes, insurance, maintenance, all that was costing them a lot every month. When they sold and rented a bigger house in a suburb they loved, their rent was $3,000 a month. Meanwhile, the portfolio started paying out $4,000 to $5,000 a month in dividends right away. So let me think through that. They're paying $3,000 in rent. They're collecting $4,000 to $5,000 in income. That means they were living for free and still had $1,000 or $2 left over every month to reinvest. That's a complete flip. They went from paying to live somewhere to getting paid to live somewhere. And here's what nobody talks about. Since they sold in 2021, Vancouver home prices dropped about 12% from the peak. So they didn't just gain income, they dodged a decline they didn't even see coming. Now, I'm not telling you to sell your house. That's not the point. But I want you to ask yourself one question. How much equity is sitting inside your home right now, just sitting there? And what would that money pay you every month if it were working for you instead? That's a question worth running the numbers on, even if you never sell. So now you know the decision, you know the backstory, but before I show you what's actually inside their portfolio, I need to walk you through something first, because if you don't understand this next part, the yields I'm about to show you are going to blow your mind for the wrong reasons. The one thing you have to understand first. Okay, this part matters, really matters. The funds this couple uses are not your typical dividend ETFs. They're not holding Johnson & Johnson and Coca-Cola and collecting 3%. These are covered call ETFs, and they work differently.
Here's the simple version, and I'm going to keep it simple on purpose. A covered call ETF holds stocks, big ones, Think the S&P 500, the NASDAQ 100, the names you already know. But then the fund managers do something extra. They sell options contracts on those stocks. Those options generate premium, and that premium gets passed along to you as part of your monthly payout. That's why the yields are so much higher than a normal index fund. You're getting stock dividends plus options income stacked on top. Pretty cool, right? But, and here's where I need you to lean in, there's a catch that almost nobody explains properly. Here's the myth. You see a fund paying a 20% distribution yield and you think, wow, I'm earning 20% on my money every year. Here's the truth. A big chunk of that payout is often something called return of capital. And I know that sounds technical, but here's what it actually means. The fund is handing back a portion of your own money, your own investment. It shows up in your account looking like a dividend. It feels like a dividend, but it's not new money earned by the fund. Sometimes the fund is literally just giving your dollars back to you and calling it a distribution. That doesn't make these funds bad, let me be clear about that, but it means you have to look at two numbers, not one. You check the distribution yield, that's what the fund pays you, and then you check the total return. That's what actually happened to your money, including price changes and everything else. If the yield says 12%, but the total return says 2%, those numbers are telling you very different stories, and the total return is the one telling the truth. Here's how I think about it. The distribution yield is what the fund promises. The total return is what it delivers. Smart investors never look at one without checking the other. That's the habit that separates people who build real income from people who get fooled by big numbers. All right, now you've got the framework. Now you can actually evaluate what I'm about to show you. Let's look at what they own. What's actually inside their portfolio? So this couple is based in Canada. Their funds are listed on the Canadian Exchange. I'm going to walk through each one the same way. What it holds, what it yields, what it costs, and where the trade-off lives. Same lens for every fund so you can compare them properly. Then I'll give you the US versions. Their biggest holding pays a distribution yield above 25%. And yeah, I double-checked that. 25%. The fund holds a mix of sectors, uses about 25% leverage, that means it borrows money to invest more, and it writes covered calls on up to half the portfolio. It pulled in over $1 billion from investors in its first year alone. People want this thing. But here's where I need to be honest with you. A significant portion of that 25% payout is return of capital and capital gains. Not all of it is new income. And while the headline management fee looks cheap, the real cost, once you add in underlying fund fees and borrowing charges, is a lot higher than what's on the label. Their second fund targets U.S. large-cap stocks with covered calls and similar leverage. Yield is around 11 to 12%. Total return since launch? About 13.5% per year. That's actually solid. The total return is keeping up with and even beating the distribution yield, which means the fund is earning what it pays. That's what you want to see. But, and here's the trade-off, the all-in expense ratio is 2.37%. That's real money quietly leaving your account every year. And in 2022, this fund dropped about 31%. Leverage is a powerful tool, but it cuts both ways. Their remaining funds follow the same playbook. NASDAQ and S&P covered call strategies, yields in the 12 to 14% range, fees approaching 3%. Now let me do what I think is the most important comparison. What if they had just put the whole $580,000 into a plain S&P 500 index fund? Honestly, their portfolio would probably be worth more today in total value. But, and here's the trade-off that changes the whole conversation, it wouldn't be paying them $9,200 a month. A standard S&P fund at its current yield would pay them something like, let me think, about 1.5%. So 580 times that is maybe $800 a month, somewhere around there. Maybe up to $1,500 if you include some of the recent yield bumps.
Big difference, huge difference actually. So the question isn't which approach is better, it's what you need your money to do for you right now. And that's a deeply personal question. Nobody can answer it for you. Quick question before we move on, and I'm genuinely curious about this one. If you had $500,000 sitting in your account right now, which would you choose? Maximum growth and let it compound for the long run, or maximum monthly income you can live on today? I've been going back and forth on this myself. Drop your answer in the comments. I read every single one. All right, so now you know their strategy. You know the honest trade-offs. But here's the thing. Their funds are Canadian. You can't buy them in a regular US brokerage. So let me translate all of this into something you can actually use. What this looks like for you. Okay, first, important note. This couple's numbers are in Canadian dollars. 580,000 Canadian is roughly 425,000 US, and 9,200 Canadian per month is about 6,700 US. Still impressive, but it's a meaningful difference when you're running your own numbers. Now, here are the closest US equivalents. Same lens as before. JEPQ, the JP Morgan NASDAQ Equity Premium Income Fund. This is probably the best all-around option right now. Current yield around 12.8%. Expense ratio is just 0.35%. Way cheaper than the Canadian funds. Almost $41 billion in assets. And here's what I like about it. It gives you real growth alongside the income. The price hasn't been eroding the way some older covered call funds have. That's a good sign. JEPI, its older, more conservative sibling. Yield is lower, around 8.2%. Same expense ratio, but it holds up better during downturns. If JEPQ is the gas pedal, JEPI is the seatbelt. Having both makes sense to me. QYLD, the Global X NASDAQ Covered Call Fund. Yield around 12%. This one has been around the longest, so you can actually see the track record clearly. And the track record is honest. The income has been consistent, but the share price has drifted down over time. That's the NAV erosion I was talking about. The money is coming in, but the foundation is slowly shrinking. You need to weigh that. QQQI, the NEOS NASDAQ fund, yield around 13 to 14%. And here's what makes this one different. It uses index options that classify most of the distributions as return of capital for tax purposes. That means if you hold this in a taxable account, you're deferring your tax bill. That's actually a pretty clever structure if you're investing outside a retirement account. All right, now let's do the math. And this is the part I want you to really pay attention to, because this is about your numbers, not theirs, yours. Let's say you build a blended portfolio of these funds averaging about 10% yield. That's realistic. That's not reaching for the stars, 10%. So you take 300,000 and multiply by 10%. That's 30,000 a year. Divide by 12, 2,500 a month. Not bad for doing nothing. 500,000 at 10%, 50,000 a year, about 4,100 a month. Now we're talking. That covers a lot of bills. And 860,000 at 10% gives you about 7,100 a month, which is basically what this couple earns when you convert Canadian to US dollars. Now, one more thing, and honestly, this might be the most important point in the entire video. Where you hold these funds changes everything. In a regular taxable brokerage account, most covered call distributions get taxed as ordinary income. That's your highest tax rate, up to 37% at the federal level. On $4,100 a month, that's potentially over $1,000 a month going to taxes. That stings. But in a Roth IRA, that same income comes out completely tax-free in retirement. Same portfolio, same yield, totally different outcome in your pocket. If you're serious about building dividend income, maxing out your Roth and getting income-producing funds inside it should be priority number one. And actually, let me correct myself. It should be very high on your list. Priority number one is always having an emergency fund. But after that, Roth. What I want you to take from this. So look, we've covered a lot. You know the strategy, you know the funds, you know where the math works and where the cracks are. But I want to zoom out for a second, because this story isn't really about ETFs. This couple, he fixed cars, she answered emails from a home office. They weren't making six figures. They weren't tech founders. They just made a decision.
They looked at the equity trapped in their home, they looked at what that equity could do if it were working for them, and they chose monthly income over a mortgage. And now their kids are 6 and 4. They homeschool them. They've lived in Bali. They've lived in the Dominican Republic. Last year, they spent 16 months as nomads. 25 moves in 16 months with 2 little kids. That's wild. And they loved it. Could they have more money if they kept working until 65? Yeah, probably. But they have their mornings. They have slow breakfasts with their kids. They have Tuesday afternoons at the beach. And that's a calculation no spreadsheet can make for you. Now, I want to be straight with you about the risks, because I'd rather you hear it from me than learn it the hard way. Return of capital can shrink your portfolio over time if the fund isn't earning what it pays. Leverage amplifies losses during downturns, and expense ratios near 3% are quietly eating your returns every single year. If the market drops 30%, a leveraged covered call fund can drop even more. You have to go in with your eyes open. But here's what I hope you take from their story. You don't have to do what they did. You don't have to sell your house. You don't have to quit your job. But what if you took even a small part of your portfolio, 10%, 20%, and moved it into income-producing funds? What would an extra $500 a month feel like? What about $1,000? That's not retirement, that's breathing room. And sometimes breathing room is what changes everything. Here's the one line I want you to walk away with. Write it down if you need to. Your portfolio should work at least as hard as you do. And if it's not paying you, it's time to ask why. If someone you know is thinking about building dividend income, whether they're 30 or 60, send them this video right now. It might change how they look at their money. Now, here's my question for you, and I really want to hear this one. What's your target monthly dividend income? What's that number for you? The one where you'd feel like, okay, I can breathe now. Drop it in the comments. I want to know where you're aiming. If you're building income from your investments and you want to keep learning strategies like this, subscribe to this channel and hit that bell. I put out new research every week.